All right, good evening, everyone. Welcome to the Hurley Investments Market View Commentary, as I call it, the high commentary for January the 25th of 2021. Have some interesting stuff to go over with you tonight. Some things to have you think about as we're trying to best understand where to put money to work this year and how to be ready for a potential drop. It's really interesting that the honest truth is, obviously no one knows exactly where the market's going to go. But are we going to learn from last year or not? That's the question. S&P index rose 1.9% last week. Sorry, I had someone just type in something funny that made me laugh. Positive reaction to U.S. President Joe Biden. And we had a couple of strongly expected earnings from companies like Intel, but our banking and financials were awful. So yes, it was nice to see a technology company, but again, I don't understand how the technology company outweighs the trillions of dollars that the financials run. It's just a big difference. Interesting part, it failed to get back to highs. So if I went down, I took a look at our S&P chart. We're getting, that's not the S&P, that's the Dow. We're getting a pretty clearly defined double top. 3 dojis in a row. Boy, that's just making for a, I wonder what's going on. Down the Williams percent R, we are overbought. We are close to overbought on the S&P. All of these data points have to start jumping into what's going to happen and why, and where we're going to go for this year's stock market. COVID. We're going to go up to 1 million doses a day. Well, Trump had us up to 930-ish. I kind of want to say, can't you do more? I would rather see them push for more doses than a shutdown. Boy, I think we had 25 million cases and 400,000 fatalities now. Those are some horrific numbers. We are running into numbers that are going to be 10 times as worse as they were in last March and April. That does not mean our stock market will fall 10 times as much. That's not what I'm inferring. That's not what you should expect. But you should understand that the expectation is have a worse fall than last time because the numbers are worse. It's funny because this is the Pulse by whitecharts.com. Some bellwether companies, including Intel, just to let you know, Intel has not been a bellwether for probably 4 to 6 years. So please don't consider Intel a bellwether stock. It is not. Communication sector, large percentage increase at 5.4%, 4.3% in technology, 2.6% consumer discretionary. Not consumer staples, consumer discretionary, which is interesting because I thought we would have had more people not having money and showing this type of increase. I found that kind of unexpected. Financials fell 1.9, energy slipped 1.6, other sectors in red, materials, consumer staples, industrials, utilities. Talking about a bubble or a shock to the economy, if people are not spending money on their consumer staples, then we're obviously looking at it not being as prepared as we were as last time. So here's all I'm going to say. If you don't have enough toilet paper, go buy toilet paper. Netflix jumped 13.5%. I'm going to kind of go through these because it's not really important. But just a general idea. Bank of America fell. Yes, we can buy another 10% more shares of stock because of our protection. The key is going to be earnings this week. We have some of our big ones for this week. Apple's one of ours. Facebook could be some of ours. If I take a quick peek, Boeing is one of them. GE, Lockheed Martin tomorrow. Starbucks tomorrow. Freeport McMoran tomorrow. Alaska Airlines tomorrow. Boeing, Apple, Facebook, and Tesla on Wednesday. That are the big ones. Visa on Thursday. So we have some that we're going to be watching and spending quite a bit of time to be prepared for earnings. Kevin, how are we prepared for earnings? You get your protection on and you're ready to watch support levels to possibly add a second level of protection so you can make more on the way down than the stock's lost. That is how we're trying to be protected. I still have this information in here. I'm trying to update it for you on a pretty regular basis. Kevin, how are you updating it? I'm updating it by just going to the E-Trade sites. So I'm just going to E-Trade and saying, hey, where are we at? What are we doing? Give me a second. So again, I just go to trading. I go to quotes. I look at Baidu's the next one. It's estimated to the 25th. That hasn't changed from our what we had over here. So when that hasn't changed from what we had over here, I just literally go on down. Micron's next earnings are estimated on the 24th. Nothing's changed. And literally, I just go down this list. Hey, confirm Target's next earnings. 3-02, and I'm getting that in this area right over here, so you know. I'm just going to quotes, and it says before the market opens, so I type in before the market opens. And that's how I'm updating our list. That's how I'm just verifying when our earnings are happening so that I can get it out to you guys to be ready for it. If you're not prepared, you're not going to be ready for your market, your earnings, your opportunity to make some of your biggest returns. So that's all I'm doing. It's nothing really sophisticated. I'm just bouncing it off what E-Trade says. Again, I still would think our markets will go down this week. They did rise last week. I was wrong, but we're coming to the end of the month, so I would expect to see a sell-off the end of this month. That'll maybe pull us off of some overbought on our main indexes. Dow Jones is still bullish. If I made a run and took a look at the S&P, still bullish, and the S&P worries me because as you look at the S&P, this distance, and I'm going to choose a pen color. I'm going to choose bright red. This distance always tightens up. And the average for the distance is like one standard deviation, which is 3%, roughly. So 3% of being 1 standard deviation away from the 50-day simple moving average says 37. That says 381. So anything above 381 is ripe for a little movement back down closer to that blue line, which is your 50-day simple moving average. Any questions on that you guys want to ask? It's really just a probability algorithm that says if you get within a certain standard, a certain percentage of 1 standard deviation, which I believe is roughly 3%, the stock market should pull back. And there you go. That's how, if it's looking above, when it's above 37, yeah, when it's above, it's actually 3,811, not 01. It's just 37 times 3. So it should be 111 higher than 370, 3,700, which should be 3,811. Bunch of boring math for you. It's what I do during the day to make sure we're being smart. NASDAQ, it also is bullish, but it is also a standard deviation higher, and it's also overbought. So the NASDAQ is ripe for a pretty good size pullback. Now, something that's going to be a little different. The NASDAQ will have fabulous earnings. It's my belief that technology was probably the #1 real Christmas gift for people. So that, plain and simple, if it's the real gift, it's going to have a great quarter. What will hurt technology is guidance. And again, when you go and spend thousands of dollars on iPhones and iPads and computers and stupid garbage like, what did I get? What are these? These are No-Bird barbecue thermometer, Bluetooth thermometers. So I've got Bluetooth thermometers that were one of my Christmas gifts that my wife spent who knows how much money, so I could sit on my butt and see the temperature of my brisket as it's smoking in the smoker. Way to make me lazy, honey. But I love that woman. I'm still going for a 0% return in January. And if I go and check the year to date, some of you are going to say, but Kevin, it's not, it's got to be better than that, right? It's got to be better than that. It's the S&P 500. Let me see where we're at. Year to date, and I'm going off of the CNBC Google app. Year to date is 2.64%. And we've already seen 1.5% declines year to date. So do I think earnings can muck up the returns for January? Definitely. Definitely, I think there's a worry here. GameStop did amazing, but if you look at Monday, Fuller Homes, Kimball, what the heck is that one? I don't remember. Tuesday, 3M, American Express, Citigroup, D.H. Horton, Johnson & Johnson, Raytheon, Verizon, UBS, AMD, Capital First Financial, First Five. There's a lot in here. A lot of those aren't going to do well. Wednesday, Abbott Technologies, AT&T, VF Corp, Cree, Las Vegas Sands, Levi's, Whirlpool. I mean, Whirlpool will probably have some great numbers, but their guidance is going to be lower than expected Who's out buying a bunch of washers and dryers and refrigerators after the holiday? It's just not a consumer discretionary item that people are looking to spend money on. Mosaic, not Mosaic, MO, Altria on Thursday, Alaska Airlines, JetBlue, MasterCard, McDonald's, Love, which is Southwest, Valero, US Steel, Western Digital, Visa, Friday, Caterpillar, Eli Lilly, Honeywell, Johnson Controls. I mean, there's just not a whole lot that screams to me, hey, we're going to be in great shape. I just don't see it. Not to mention Friday's the last day of the month. We'll probably have a bit of a sell-off. We're going to have a bit of rebalancing. Earnings reports, Case Shiller tomorrow, consumer confidence tomorrow. That'll be a big one. Durable goods on Wednesday. There is an FOMC rate decision, but nothing's going to happen. It's kind of one of those FOMC rate decisions that you can just not spend any time on. It's not a worry. What else do we have here? We have new home sales leading indicators and GDP on Thursday. That'll set our futures even above and beyond earnings. Friday, personal income, personal spending. Those two will be the big ones that we worry about. Internationally, I didn't even look. I forgot to look. I don't know what's moving internationally because I never looked at it. Something I should probably have prepared before I start out my week, right? So tomorrow, Bank of Japan monetary policy. Actually, that was today. It doesn't matter, or it hasn't come out yet. So the Bank of Japan monetary policy. Great Britain's claim unemployment rates, not important. I'm looking for the big red ones. Australia's trimmed mean CPI. What's their inflation? Not important. U.S. durable goods, U.S. interest rate decision. That's monetary policy. None of it's going to really matter. Thursday, European harmonized index of consumer prices. Inflation, not important. U.S. GDP, huge. Bunch of stuff going on in Japan. Nothing's really that important that stands out. Kevin, how do you know that? Experience. It's experience. Nothing really matters with the GDP for the European Union, right? Ooh. Hey, how about gross domestic product for them? Well, it's supposed to be important, but no one's cared for forever. Not much going on internationally, so we don't need to worry. All righty, what else do we have? Prepping for earnings. So the short answer is same thing. We've got protective puts in place on just about everything. We're prepared for earnings. We're going to add short calls after the earnings announcement, probably farther out in time, out to April. For example, if we have Apple tank, we will probably add a 140 April short call, knowing it'll probably go down below 135. In fact, let's bring up Apple. Let me go through how we're making some of these decisions here. If Apple has bad earnings, we know it'll most likely fall through its highest point and its pivot point. So Apple, if I was to look at this chart, they have bad earnings. They will probably fall down to the 130 range, which case I'm going to look at the 140.98 pivot point out in April, knowing that pivot point is going to come down in price as Apple fell because of the bad earnings. I'd be looking at an April 140 call because I can get $3 or $4 for it. If they break the 130.50, I know I've got a little bit of support down here at 126. If they break the 126, it's the 115 level. And I'm just getting that from where it's held in the past. And that's how we make our decisions. Hey, Apple had a bad earnings. Let's get those short put short calls on. Let's try to make every dollar on the way down. Hey, it broke 130. Do we add long puts, a second set at 130, farther out in time? See if it holds the 126. If it breaks the 126, maybe we'll roll down the current 144s or 142s or 138s, wherever you're at. We might roll those down to 125 and play two sets of puts down to 115. At 115, let's uncap our stock. Let's take off our short calls and book that profit. We should have made up over 90% of that downward movement anyway. Hey, let's take off the 130s. We should have had a great profit there. In fact, at 115, hey, maybe we're going to keep those long puts on, and that's where we're going to add some shares. 145, 144 down to 115. We're talking about what, $29 movement down? We should be able to buy another 100 shares. Add another $4 on the credits. Maybe we're at, $32. Hey, maybe we can buy a couple hundred shares. That's how we look at it. Now, I know some of you are going to say, well, Kevin, what if it stops at 126? Maybe that's where we take off our short calls, but we'll leave our long puts for a couple days to prove it. Maybe if we added another set at 125, or if we haven't yet, maybe we'll roll the 144s or 142s, 138s, we'll roll them down to 125s and see if Apple proves himself to then take them off. It's where you're going to have to be nimble. There's not really an exact amount that you do. You look at it, you allocate what's happening, where you're going to go, and you make your best choice your best educated decision on what's happening at that time. That's what we're looking to do for this earnings season. Anything that really doesn't have a good level of support, we're looking to add the short calls. Kevin, have you done it with the banks? No, I haven't. Should I have? Well, in retrospect, yeah. I mean, to make a long story short, should I have done this with Bank of America? Definitely. Most definitely. Look at that drop, dang it. We had 34 long puts on, so to miss it by 37 cents, not bad. We missed it by 0.1% for where our long puts are at. But we have a support level that's holding. I definitely should have stuck on 34 a couple months out. Boy, what a nice return we could have had there. Kevin, where do you think it's going to go? Probably going to go down to that $30 level. We've got a pivot point. We have a 50-day simple moving average. We have a horizontal level of support. Horizontal level of support, pivot point, 50-day simple moving average. That's where I'm going to take a risk, cash into long puts, add some shares. Could it bounce a couple, 5% higher from here? It could, but that's my trigger or pivot point, or where I'm going to look at taking a chance, adding maybe 20% more shares of stock, letting it run for a day. JP Morgan. Crap, if it doesn't look exactly the same. Although it didn't pass through its R1 resistance level, it's holding that right now. It did bounce, it's holding its R2. It did pass through, it bounced off of R1 and bounced back up today. I'm not sold on it, but if you're looking at this chart, where am I going to make my decision on where to take some protection off, cash in those long puts, maybe dollar cost average, some leap bull calls? Taking a look at this chart, where would you do that at? Any ideas? I just showed it to you on Bank of America. There we go. Perfect. 125-ish. 124. Either one, that works. But yes, 125, because we have that base. We have the 50-day heading up. We have a pivot point at 124. At somewhere between 124 and 125, I'm going to take a chance. Pivot point at 123.28. 50-day at 124.12. And 125, more of a horizontal level of support. That's where I'm going to start to nibble. Kevin, what if you're wrong and it keeps going lower? What do you think my answer is going to be if my first day I add shares, this stupid thing bounces below 128, 123, 28? If it falls below that lowest number that I have, looking at support levels, what do you think I'm going to do? What would you expect me to do, considering I'm the one that's here protecting your money, right? Do you want me just to sit and wonder if it's going to bounce back? Tell you just to sit and wait? What would you expect me to do? Wow, 3 of y'all at the same time. Add puts, add puts, add puts, wait another day or roll down, add puts. Exactly. Add that insurance contract. What if it bounces up the next day and we lose a little bit on it? What if I get jerked around? Well, if I can add 20% more shares of stock and I get jerked around a little bit and maybe lose $1 on protection, I'd rather be overprotected going into this next quarter than underprotected. I'd rather make sure that if we see what we saw last year, we get to do the same thing and have the same results from last year. And we didn't get that by not being protected. In fact, there are quite a few times last year that Keith and I looked at each other and went, oh, should have waited another day. Bounce back. We kind of knew that was going to happen. It's okay to lose a little when you gain a lot through the earnings event. The earnings event, that was the key. That was the trigger. Way up here, and we did a great job way up there for the earnings. If I can go back on both of these charts, Bank of America, $34 our protection, maybe even $34.50. Great spot. Apple, earnings on Wednesday. Finished at 142.92. We have it collared. It's right between there. We got some protection at 144, some protection at 142. We're good. We're in a good spot. Well, Kevin, you don't have 92 cents protected. Nope. Maybe if it bounces up tomorrow, we'll try to put everyone at 144. But the reality is, we're pretty much locked in here. Expectation, Apple's going to have a monster number. They will probably make more money this last quarter in one single quarter than they've made any other one single quarter in their lifetime. But overbought. But doji. But institutional money's there. In fact, who the heck isn't invested in Apple right now in some way, shape, or form? If you ask Keith and I, we're probably going to take some calls off. Some of the long calls on Apple, let's reduce it. Let's take some profit. Let's lower them down. Let's not let so much ride. We can always add some more long calls later, but it just isn't prudent to be going all in right now. And it's shocking because some of the money flows are showing a lot of people are going all in right now. And I think to myself, how dumb is dumb money? Could we still go higher in the next year? Yes. But right now is not the ideal time to be entering into the stock market. In fact, I found some pretty interesting articles I'm sharing with you today. Legendary investor Jeremy Graham says Biden's 1.9 trillion stimulus plan would take the stock market bubble or make the stock market bubble even worse. We are overvalued. And the worst part about it, we learned last time on $600 and some PPI loans or whatever they call it, PPE loans, only 268 billion of the 900 billion was directly for the US. How the hell we're paying all these billions of dollars to other countries, I don't understand. But if you do that math, if we're going to go 2.3 times more on 1.9 billion, 268 times 2.33, that only comes out to $624 billion. So it makes me wonder, where the hell is the other 1.2 trillion going? I haven't looked into it yet. I don't know where it's at, but it worries me. It worries me something fierce. But if the U.S. on the last $900 billion gave the U.S. citizens $268 billion, 2/3 went elsewhere. Here we go again. Where the hell is 2/3 of a $1 trillion package going? It's a very interesting article. I like Emily Graffo. She does a good job. But definitely take a peek. I kept the link for his investor letter there. I usually erase that, but I found his investor letter extremely interesting. That link is going to be there. Or just research, or maybe I should probably add it in. I'll just add it in. I'm going to get that link. I'm going to add his investor letter in there at the bottom of this, just so you can see some of what he said. I liked it. It was pretty interesting. And it's something that's that might help you understand where our markets are going. So here's a huge bull that's telling you watch out. Social Security, I kind of chuckle. Social Security was doing great until Bill Clinton pulled the profits off of the trust from Social Security to balance his budget. 2035, Social Security will no longer be around. What am I trying to say here? Don't count on Social Security. And the worst part about it, and what bugs me the most, we're going to pay more taxes to try to fix where a president balanced his own budget per se, which is bullcrap. It's not an entitlement. We paid into it, but your financial planning should include the fact that you're going to get significantly less of your benefits in Social Security and that it probably won't pay you out. If you're in that 50-year range, plain and simple, don't count Social Security in your financial planning and count it as a bonus if it's available. And that's going to be something in the next 15 years. Interesting article came out of, I thought, my local newspaper here, but pretty interesting to take a peek at it. Do go through and read it. You'll find it interesting. Again, I disagree. It's not an entitlement program, but it's not solvent, so it's going to be in trouble. And last but not least, we've been hearing a lot about SPACs. A SPAC this, a SPAC that. I had a couple interesting emails where people said, Kevin, what is a SPAC? A SPAC is a special purpose acquisition company. It is a company with no commercial operations. It is structured strictly to raise funds through an initial public offering. With the capital raised, a SPAC then identifies a private company to merge with. So a SPAC stocks are nothing more than an IPO that does not have to go through the same Securities and Exchange commerce rules and regulations. And after a while, it turns out that it has the opportunity to be acquired, and its shares turn into real shares of a company that's currently listed on the S&P 500. It's interesting. I tried to put something in here to teach you a little bit about SPACs, and maybe down below I'll put you a couple links to a NASDAQ article. Maybe I can find another couple links on just what it is. But a special purpose acquisition company is nothing more than a publicly traded company that has no product, will not have to go through the rules and regulations of getting licensed to trade on the market, but that will hopefully be bought up and incorporated into some other company that can use its services. Consider it a blank check company. It's a blank check type company that has nothing. That's not fair to say. It has an established business plan. It's gathered its funds, but it has no intent of becoming profitable. Its only intent is to merge or to be acquired by another business entity that's already trading on the S&P 500. If you're looking into these, if you're worried about these, it's a 100% gamble, and you don't want to spend your time focusing on it. I've missed a couple things, a couple comments. Let me just go ahead and read a couple of these. Then you can't count on Medicare either. Both Social Security and Medicare will be going belly up at this rate. And the comment that's related to that, never rely on the government. I agree. In all honesty, I think we make our own way in the world. If the government's making your way in the world, there's some problems. There's some problems there. But yes, that's what I have for today. Any questions you guys have that I can answer for you? Any questions whatsoever? Kevin, what do you think about earnings? So, William, I knew you were going to ask that, and way to put me on the spot. I should probably open up Keeb's microphone here too. But the short answer is, William, Keeb and I have spent a lot of time in the last couple of weeks crunching our numbers, and we're worried. It is a coin flip. I could see companies going up. I could see companies going down. But fundamentally, the stock market is overvalued right now. The earnings per share don't justify the growth that we had last year. They certainly don't justify it this year. We haven't cured the pandemic. I can find reason after reason after reason to justify why we could have a serious drop to the downside. So the next question everyone asks me, well, why don't you sell out? And when it gets a bottom, you buy back in. Well, with all due respect, I appreciate the compliments And I hope you appreciate the money that accounts have made last year. But if your goal is to have me outguess the stock market, we need to talk. My job is not to outguess the stock market. My job is to make you as much money as possible without taking the stock market risk that's out there for us, which means I'm going to buy some insurance on my stock. I'm going to never miss an update in the stock market. I'm going to be able to, and Keeve will be able to, I'm saying but Keeve does exactly the same thing. I'll be able to dollar cost average without asking you to put more money into your account. Most importantly, we're trying to double portfolios every 4.5 to 5 years, not waiting on the market who did it 20 years last time. It took 20 years for the stock market to double. And just so you don't say, Kevin, no, really? Yeah, really, the real God honest truth. Where are you? Where are you? There we go. If you take a look at 2000, was it 1500? The last time it passed 3000 and stayed above it was last year. I'm sorry, that's 19-20 years for the stock market to double. If you think your 401k has doubled in the last 20 years, it's only doubled because that's how much more money you and your company put in. Your 401k has not doubled because of growth. In fact, you went, if on the top side, 13 years without doubling your portfolio. On the low side, you lost 7 where it did nothing. It was flat. Absolutely flat. And that's picking it off the bottom. Well, Kevin, what if you started investing in 09? Well, if you were lucky enough to start to invest in 09, then yes, you've had a 300% return. I get it. You're lucky. But if you want to count that, and if we do have this massive drawdown in the next 4 years, don't be surprised to go from a 300% return to then going back down to 100% return. And I hope you're okay with it, because that's what stock markets do when you just let it ride. That's why we protect, where if it goes down to 2000, boy, we're going to pick up 60, 70, 80% more shares of stock, and we're going to be in a really, really good place. So, William, I hope that answers your question. I hope I'm not coming across as a little angry or frustrated. That's not my intention. I just need you to understand what your money's doing and why. Here we go. What sector of will shine this earnings quarter? Well, technology. Technology should do really well with sales last quarter. With that said, some retail should do really well after a Christmas quarter. With that said, some energy because of heat. But I'll be honest with you, this has not been a really cold winter out west. We're kind of going through a drought. Hasn't been a lot of snow, but usually some energy does good this quarter. The question is, will it have guidance to prolong a run into the next quarter? And you're not going to see that with technology or retail. People already spent all the money. In fact, this next quarter, literally between January and April 15th, We're trying to pay down our credit cards and save money to pay our taxes. There's not a lot of money to go out and go around during this time period. So just as a heads up, isn't market, depending on stimulus, a house of cards situation? Of course. And the funny thing is, the stimulus is supposed to reflect GDP growth. Well, Kevin, that's kind of bogus. Well, not really, because our GDP is supposed to be 70% consumer driven. We're a gluttonous people. The problem is the numbers don't add up. 1.9 million does not go into a GDP number. In fact, on the last 900 billion, only 268 could possibly go in. And not all of it goes into GDP because we're paying off the debt that we're already in. I would bet out of that 268 billion that could have gone into GDP, I bet it was only 100 to 120 billion went into the GDP number. There was not a bump that would be considered significant for the GDP for the United States. If 1.9 trillion could all go into GDP, that's huge. This time around, what did I come up with? Taking 268, multiplying it by 2 1/3 times, because we're going to get $1,400, right? What did I come up with? I came up with 628 billion. Maybe that holds us off through the March, April, probably worst COVID time period the United States has ever had. Which means we're kicking the can down the road. They pay 1.9 trillion. The US gets 624 billion. We spend 300 billion of that, maybe half of it, 350 billion. We get a bump for the first quarter. Guess what? Sell in May and go away. Damn straight for people that can't protect. Maybe we're going to push off our drop of 28.86% like we had last year that could be out to 35 or 40% this year. Maybe we push that out a quarter and it happens May, June of this year. There's so much up in the air. New president, new rules and regulations. You know what I do know? Guess who is now importing soybeans, rice, and corn from China? This is after we sent back like 20 million gallons of ice cream that had COVID in it. Oh, Jim knows, US of A. Let me put this to a realistic understanding. And I found this out on Facebook, no less. And they're right. Every small farmer that has 100 acres that's trying to get 200 bushels, every small farmer that has 1,000 acres of land, then get somewhere between 200 and 220 bushels of corn, just lost $100,000 or roughly, 12.5% of their income because we're going to give it to China. On the flip side, Biden sent executive order that's going to increase the cost of insulin. That is not true. All the insulin that's here is here to stay. It's at that cheaper price. But for more insulin going into the future, he just put the standards back up where you can't pass it with a phase 1. You can do a phase 2, phase 3 trials and so forth. The newer stuff will cost more money, but the old stuff is still going to be cheap. So be careful what you read. You've got to look into it because it's not all true. And it's just something to pay attention to when you see weird crap coming across Facebook or whatever. It's always interesting. Trust but verify, which I might save off of Facebook. Just listen to and verify it. But yeah, that is so disappointing that I just don't understand what our government does sometimes. Well, a tariff was just a tax. Well, did you notice how much more money you spent on corn, rice, and soybeans last year? or the last 3 or 4 years? Was that tax so much more that you went broke buying corn, soybeans, and rice last year? Would it have been more important to give it to our U.S. farmers? I'd say yes. Just the way I feel. Any other questions coming in that I can answer for you? If not, guys, I appreciate your time. Thank you for being with us tonight. We're going to send out an email that most likely tomorrow that's going to start to prep for expectations of earnings. Maybe even that'll go out tonight. But we do have some earnings that we got to pay attention to. We're going to send out an email that preps you for earnings and that are coming up. Thank you for saying thank you. Good night, Abraham. Thank you, William. Thank you, Dave and Mary. I appreciate it. To the rest of you, I wish you well. I wish you well. Please get on. We're going to have a wild ride most likely through this next quarter. Be ready for it, and we're going to do the best we can to protect you as we always do. Guys, take care. Have a wonderful evening, and I look forward to seeing you if you wish to attend Trade Findings and Adjustments tomorrow night. That is at 6 p.m. Mountain Standard Time. Until then, have a good evening. Bye-bye.